Welcome everybody to the Investonline Offshore Investment webinar. I think this is a really important subject that we're going to be covering. There's quite a few important details and hurdles that we're going to go over. Just a little bit about us this week. I'm Nick Brunner. I'm the director and founder of Investonline. Joining me is Stuart, my fellow director. He's head of our portfolio managers, and Stuart's actually going to be doing the presenting. I'll be chipping in here and there. Investonline is a financial planning business, and we're registered with the FSCA. I'm a member of the South African Institute of Chartered Accountants, and Stuart, he's a certified financial planner and a member of the FPI. Investonline operates out of Cape Town, Newlands. We're a team of 10, 7 professionals and 3 admin. The name Investonline, the original concept came from providing a cost-effective and more efficient service. But effectively, we are financial planners and investment advisors. We highly qualified, experienced, and provide independent advice. That's really our introduction. Enjoy the presentation, and over to you, Stuart.
Thanks a lot, Nick, and thanks to everyone for joining. I think what we're going to go over today, let me just go over briefly the webinar agenda. I think what we're going to get started with is what we've got with offshore investing. The way we think about it, there's a lot of benefits to investing offshore, and I think quite a few obstacles that often one needs to get their head around. So that's what we're going to cover to start with. Then the practical side of getting your money offshore, the exchange control rules in South Africa. So we're just going to cover that briefly. Once your money is then offshore and in foreign currency, what are the different investment options and the different account options that one has? I think a very popular investment account, and really what we're going to cover in quite a lot of detail in the webinar, is an international wrapper. So an international wrapper is something we're going to go into a little bit of detail on, the key benefits of what a wrapper provides. And we've got some nice illustration with an end example of what the tax and estate planning benefits are if you had to wrap your offshore assets or your offshore investments. So the whole webinar is not a long webinar. I think we've aiming for around 30 minutes, including questions. We don't have a live Q&A chat function, but there were some questions submitted ahead of time. So I think Nick has selected a few that we're going to go through at the end. So let's just get into it. In terms of offshore investing, benefits and obstacles. To start with, benefits. Obviously, a big term that's used and read about quite regularly is offshore diversification. What does that really mean? In our view, it's a few things, a few benefits that diversification gives you. It's access to international markets and international investment returns. When you invest locally, obviously your investment can become quite tied to local economic activity and local company performance. The South African economy is relatively small on a global scale. When you invest offshore, you can get access to all those international markets and obviously the investment returns that those markets provide. Holding capital directly outside of the country, that can be quite important to keep your capital flexible, and not having all of one's capital in traditional retirement funds means that you don't have to abide by those retirement fund rules. Like in South Africa, we have what's called Regulation 28, which dictates how you can invest your money. If you invest your money directly offshore, you do it properly by taking money offshore through the government rules, then you can invest in basically whatever you want outside of the country. It's very tax efficient to invest offshore, which we'll go through with some good examples. It can protect you against inflation in South Africa. So that's economically, it's quite a technical issue, but having your money in foreign currency can obviously protect your money in global terms. So as the rand weakens, and it has weakened over the longer term, you are protecting your wealth, that you can continue to buy goods in the country at the same level and keep your lifestyle at the same level that you have it at. And the ability to withdraw money outside of the country. I think this is important for a lot of people, especially if you've got family overseas and you travel or you may move overseas. One might not want to bring all their money back into rands. So with the offshore investment, you can withdraw that money to a bank account in any country as long as that bank account's in your name. So just some obstacles. We don't see them as big obstacles that one can't overcome. It's more just things that one needs to understand clearly. Converting that rand to foreign currency, or rands to foreign currency, if your money sits in rands. We'll go through that. Keeping up with global market trends. Obviously, global markets are massive. All the different economies and companies out there. That can be quite something to keep up with. Remaining compliant with SARS. Avoiding tax and estate complexities. Selecting the right investment provider and product. So I think the product part of that is an under thought about issue. When people take their money offshore, they generally just want to get the money out of the country without giving a lot of thought to what sort of investment vehicle they use. And that's where we're going to hopefully highlight the importance of that thought process. And I think being able to easily access your money, a lot of offshore investment products don't give you easy access to your money, and they can be quite expensive. So I think we want to just give visibility on some good products that aren't complicated and where you can access your money easily. So just to start with here, getting your money offshore. Briefly, you may or may not know this, but essentially as individuals, you're allowed to take money offshore out of South Africa. You generally have an amount that you're allowed to take per calendar year. So it's not tax year, importantly, it's calendar year. So that runs from 1 January to 31st December. Each individual can take up to R1 million without having to do any sort of special application to SARS. They just have to tick that they are within that R1 million threshold, and they're allowed to take that R1 million offshore in each year. That can be for foreign investment. It could be if you're gifting or loaning money to foreign individuals, if you're traveling overseas, if you're studying overseas, or if you have any maintenance transfers that have to go overseas. And then over and above that R1 million, you're allowed to apply for an additional R10 million. So that's a physical application that gets done to SARS. There are some supporting documents that are needed with that, and that's really a tax clearance that's required. That tax clearance takes around 23 business days, or what's just over a month to get that. So ultimately, it's just to get SARS. If you're in good standing with SARS, SARS will often just pass that clearance, no problem. And you'll be able to take up to R10 million, and you have a year that you're able to take that R10 million out for. So once you get the clearance, you don't have to take the money out immediately. If you want to phase the money out, or if you want to try and time the exchange rate, you're able to do that. So ultimately, per person, you're allowed R11 million per person per year. So if you're a married couple, you can take up to R22 million per couple per year. Just on some accounts options, I know there's lots of different investment accounts and offshore pensions. So we've just done, I think, 2 simple ones. On the sort of the middle column, if you just had to say a normal, what we call an offshore platform account or an investment account, this account doesn't have any sort of special restrictions or bells and whistles. It's just a straightforward investment account. The minimum investment there is around 100,000 Rand that we can set that account up for you. It's very easy to put money in and take money out, but that straightforward account doesn't have any additional benefits in terms of any tax benefits or estate planning benefits. You would still get issued normal tax certificates, and you would pay tax in your own hands as if you would with any other investment, locally or offshore. What we're going to go into essentially for most of the rest of the webinar is what's called an international wrapper. Locally, you might know an endowment investment. A wrapper is very similar to an endowment, but not identical. It's a lot more flexible than an endowment. And there, in a wrapper, you can invest in different foreign currencies, generally all the major currencies. You need a minimum amount of $20,000, which is about 380,000 Rand today. And in this investment vehicle, there's nice tax benefits and estate planning benefits that come with that. So we're going to go into those benefits and we're going to kind of unpack them over several slides. So what is a wrapper? A quick introduction. I mean, the way I explain it most simply, it's just a type of investment account. Locally, if you're going to go and invest your money, you can go and invest in unit trusts. You can go and invest in a retirement annuity, a tax-free investment, and you get an account called an endowment. So a wrapper is almost like an offshore sort of endowment. The only difference with a wrapper is that it doesn't pay out when the policyholder passes away. So I'll go into more detail on that just now. So it's really just an offshore investment account that has been specifically designed for South African tax residents. So it's very tied into our tax system. When you're investing offshore, it's very easy to mistakenly create an offshore estate for yourself. If you go and buy funds or shares in the US or the UK or Switzerland, are quite common areas where people will go and invest through those banks, you can mistakenly go and create a tax estate for yourself or a tax status for yourself in those jurisdictions by owning those assets. So if you pass away and you've got shares that are domiciled in those countries, you would end up having an estate that would need to be wound up in those jurisdictions. By investing in a wrapper, you don't have any of that issue. It's all seen as being part of your SA estate, even though the money is held directly offshore. So it's a flexible and convenient investment product. Who can invest in it? South African individuals can invest in it. South African trusts and companies can invest in it, although there's a little bit of a intricacy to be able to do that if anyone is interested in that, we can explain that to them. And foreign trusts are allowed to invest in these wrappers as well. Where's the investment held? In terms of the wrapper providers we use, they are administered in the Isle of Man. So I think the important thing is that you still have a local South African service team that you're dealing with. You're not having to deal with people overseas, but where your money sits is overseas in the Isle of Man, which is obviously a very tax-friendly and estate-friendly jurisdiction and a very compliance-heavy jurisdiction, so you know your money is very safe there. So just to go through, I think, a summary of the key benefits, which we'll unpack a few of these in a little bit more detail. I'm just going to go around the wheel clockwise. What are the benefits of a wrapper? I mean, there's a really large investment universe that one can invest into inside this account. By having a wrapper, you avoid any foreign inheritance tax or any what's called situs in America, which is really their estate duty or their inheritance tax. You don't have to worry about that. You have easy access to your capital. You can bring the money to your South African bank account, or as I said earlier, you can withdraw to an offshore bank account. Investments still fully transparent. You can log into your online account and view your investment daily, see the performance of your underlying funds. It's tax efficient, which we'll go into now, and it gives enormous estate simplicity. So I like the word simplicity because when you work practically in the job that we do, you see a lot of issues that come up in winding up estates. And with the wrapper, I must say it's really a simple process for your money to pass to your nominated beneficiaries when you pass away. So we'll explain that process a little bit more. To start with, your investment options, So now your money's offshore and you've invested and you've opened your wrapper account. In that account, there's different options that one can select. I think the most common option is just to go and buy funds. There's almost 400 funds on the direct platform. So those are both active funds and passive funds that's there. I mean, you can see quite a lot of the common or the popular fund managers. We've just put a few logos here, such as Orbis, Vanguard, BlackRock, Franklin Templeton. These are really global leaders in global investments. So those are funds that you can go and buy. If you want to be a little bit more selective, you can also own individual shares or ETFs. What we have to do to be able to do that is to set up what's called a custodian account, which is just like a broking account. So you would have a broking account that would sit within your wrapper, and you could own shares in that broking account. And you could have both. You can have direct funds, cash, and shares all sitting alongside each other in one umbrella, which would be your wrapper portfolio. In terms of tax benefits, once again, I'll just go clockwise around. I think the main practical benefit that I always think is important to highlight is that your taxes from the wrapper, the only taxes that need to be paid are capital gains tax when you sell the investment at a profit, whether that sale is a withdrawal or a change of asset. So if you sell one share or fund to buy another share or fund at a profit, that's a tax event. With the wrapper, the provider, which is the wrapper provider, pays that tax directly to SARS for you. So you don't get any tax certificates. You don't have to declare any tax event in your personal income tax. So that's a real nice benefit for individuals, especially if you've got, other forms of taxable income. You don't want to add your offshore growth to your local taxable income that's already, you're having to disclose to SARS. So it's fully compliant. The institution is reporting everything to SARS directly, and SARS is very happy with these wrapper investments because SARS is getting their money essentially on time and directly from the investment institution. SARS doesn't have to go and basically go after individuals trying to get capital gains tax because the institution is paying it upfront. The tax rate at which the wrapper account is taxed is an effective tax rate of 30%. So if you earned generally over 300,000 Rand in South Africa, you're paying more tax, a higher marginal tax rate than 30%. And what they do in the wrapper is that they don't declare any interest income. So if you earn interest income as a South African resident, you have to pay tax normally as and when that interest is earned, whether that's local income or foreign income. In a wrapper, they don't declare that income. They take that income and they add it to the growth of the portfolio. So the only type of return that your investments, even if it's a cash investment, earns is considered capital gain. So the only type of tax you pay in a wrapper is capital gains tax. And that capital gains tax rate ends up coming out at a flat rate of 12%, compared to if you were a direct individual owning these assets directly, you would pay up to 18%. So there it's essentially a tax saving of up to a third, depending on the size of the capital gain. And that capital gains tax, as I said earlier, is paid directly to SARS as and when the gain is triggered and your investment is funding itself essentially from a tax perspective. So we think that's a big benefit, and it's highly simple and efficient for investors to have their offshore money without worrying about how to disclose the gains that they earn to SARS or when to disclose. We just move on to estate planning. So estate planning, I know it's something one doesn't think about when they make investment decisions normally. They often think about what they're going to buy and what shares or funds they're going to buy. But estate planning is often something that only when you do a sort of job that we do, where you see all the pitfalls or all the daily complications that come through when an investor passes away. So with the wrapper, you are able to nominate beneficiaries, which is not common for most investment accounts, especially if you're buying funds or shares offshore. And your beneficiaries can take immediate ownership of their portion of your portfolio. So if you nominate 2 or 3 beneficiaries, that contract essentially gets split up, and each beneficiary will retain that portfolio and have their percentage basically moved into their name. And all from an administration perspective, all that has to be done is that they sign an ownership form to take ownership of their portion of your portfolio. So that inheritance doesn't have to come back to rands, back to South Africa. That money can be retained offshore. So we think that's a real nice benefit. A lot of people who are moving their money offshore, they are doing it for legacy reasons. They may use some of the money in their own lifetimes, but a lot of the time we see that that money is for children or grandchildren or whomever the beneficiaries may be. And those beneficiaries can have their money stay offshore. And they then, once they take ownership, they can decide as and when they want to withdraw from the portfolio. I mean, it becomes their portfolio. Because there's no sale on death, there's no capital gains tax on death. Capital gains tax is only paid when the beneficiary who inherits the money decides to make withdrawals. So the portfolio can actually go from individual to individual to individual without tax ever being paid until one day someone starts to withdraw from that. Because of the beneficiary nomination, there's no need for a foreign will and there's no need for a foreign executor. So that's massive. Having a foreign executor is a nightmare. It means your local executor needs to appoint an attorney of some sort in the country where your money sits. If your money sits outside of the country, the local executor has to take money out of your estate to pay that foreign attorney. And often it adds a long time to the estate being wound up when that has to happen, as well as adds costs. With the wrapper, you don't have a local executor doesn't touch the money, a foreign executor doesn't touch the money. The money goes straight to the beneficiaries. You don't have to pay executors fees, which is up to 4%. So on a 10 million rand investment, that's 400,000 rand saving right there, because the executor doesn't touch the money. They don't get to charge their fees on that portion of wealth. And you don't have to pay any offshore inheritance taxes. In the US, the inheritance tax is 40%. So that's a major chunk of your capital. If you have US shares that aren't wrapped, that technically there is the IRS can come and claim that you owe them inheritance taxes. You don't owe South Africa inheritance taxes because that money sits within their jurisdiction. So that's quite you want to avoid that. So that's all on the technical issues. I think this is just the final example that we have before I hand back to Nick. What I'm going to show you, I'm just going to show you a basic investment. If you had to invest 10 million rand and take that 10 million rand and invest it offshore, these two investments are identical in what they invest in. So we've just assumed in rands, it could be seen as conservative, but a 9% investment return over 20 years. And what I'm going to show you is 3 different events that happen over this 20-year period and what the tax effect is of those events. And ultimately, just the difference if you had your money wrapped versus if you had the same investment, what's called unwrapped. If we start, obviously the first 5 years, the money grows side by side. And most investors that have shares or assets offshore that aren't selling those shares, they don't kind of realize what the tax effect or how big the tax effect is going to be until one day they either sell that portfolio or they pass away with that portfolio and their estate has to pay the costs. So the money grows side by side identically. And then what we've said at the end of year 10, the investor decides to make a portfolio change. So for illustrative purposes, let's just say they've moved all their money from one fund or one strategy to another fund or another strategy. Now, that event is a capital gains tax event. So the person's going to have to pay tax. In the wrapper vehicle will pay the tax directly to SARS. And what we've calculated is at the capital gains tax rate of 12% on the growth, which was about 13.5 million rand here, the tax would have been about 1.6 million. If your investment was unwrapped, you would have had to disclose that gain to SARS in your tax return yourself, and you would have had to physically pay the money to SARS as part of your tax return. And here the illustrative gain was about 2.5 million on this event. And this is the same portfolio and the same event, which is just moving from one fund to another. So I think that's obviously quite a big saving there, just straight away in sort of that capital gains tax event that happened. Now let's say the investment continues to grow in the investor's hands, and now after 15 years, the primary investor sadly passes away. So in the wrapper, and what we've assumed is that the money goes to the spouse. In the wrapper, the spouse is taking ownership of that investment. So remember, no capital gains tax gets triggered. And because no executor handles the money, no executor's fees apply. So actually, in this event, where the wrapper portfolio moves from the primary investor to the secondary investor or the spouse, there's absolutely no cost to that transition. It's just an administrative transition of ownership. If you didn't have your assets wrapped, you would have had to pay executors' fees and capital gains tax, assuming that that investment was disinvested and then given to the estate for the executor to handle. So there we've got a difference in expenses, 0 in the wrapper versus 3.4 million for an unwrapped asset. And then finally, as that investment now continues to go, what we've said at the end of year 20, that's the second investor, which is the spouse, passes away. And now that money goes to the children and they withdraw the money. They don't keep the portfolios, whether it's the wrapper or the unwrapped portfolios, they withdraw the money. And what we've got here is the wrapper. Now, finally, the capital gains tax becomes payable, but there's no executive fees payable because no executor handles the investment. In the unwrapped investment, capital gains tax becomes payable again for the 5 years that the spouse owned the investment, and executors' fees become payable again because now this is a second estate and a second executor that's handling that estate. So ultimately, if we look at this whole scenario, over a 20-year investment, it's basically an 8 million rand additional inheritance that the children got just from having your investment in an identical portfolio in a wrapper versus an unwrapped state. And I think that's quite a powerful message of why we think it's important to pay attention to what sort of product or investment vehicle you use when investing offshore. I see we're on 11:30, so I'll hand back to Nick. I think this is just a wrap-up slide. International wrapper as a product. Obviously, we'll always talk to our clients on a case-by-case basis, but if you're an individual tax resident without any complex trust or offshore company issues, we just think the wrapper really ticks all the boxes, gives you offshore diversification, the investment universe is massive, lots of tax efficiency, lots of estate simplicity, and really, I think does the job very well. So thanks very much. That's all from me. I'll hand back to you, Nick.
Good. Thanks, Stuart. Yeah, that was good. We've got a few questions that have come in. Thanks for sending them to you. I've just selecting a few at random. One is, I have an account. I've got money offshore in an offshore bank account. Can I just move that into the wrapper? How would I do that?
Yeah, so if you've got money offshore already, absolutely, you can move that money to a wrapper. You don't have to bring the money back into rands to do that. Essentially, what that would be is we would just inform your existing investment institution, wherever the portfolio sits, of your intention to change investment institutions. That would be a letter that we would have to send them, and they would disinvest those funds and send the money directly to your new wrapper account. So it's just really an administrative process. It's not complicated, where you just be moving your money from one institution to another. You don't have to bring the money back into rands, and you don't have to reapply for tax clearance. It's quite, it's quite a simple process. We do this regularly. Yeah.
Thanks. Okay, next one is also offshore. I've got an offshore trust. Can I move my offshore trust into a wrapper?
Yes, so a foreign trust can own a wrapper account, and it can also be the beneficiary of a wrapper account. So if the individual is the main investor, they can make their foreign trust the beneficiary. Often it may not make sense for the foreign trust to own a wrapper, because a wrapper is for South African tax residents, so it pays tax to SARS. If you have a foreign trust, that's normally set up in a tax haven outside of the country. So we don't want to put you into a vehicle where then you would be paying tax to SARS unnecessarily. But I think what's much more useful and much more common would be to have your foreign trust as a beneficiary, that then if you have the money in your hands while you're alive, and then when you pass away, your trust inherits that money. And then the trustees can determine and that decide what they do with the money. So we'd have to comment on that on a case-by-case basis, Nick, depending where the trust sits.
Okay, cool, thanks. Okay, one more. I've got a living annuity. Can I move my living annuity into the wrapper?
Okay, so that's a good question. It's quite a common question. So a living annuity is a South African pension product. So a living annuity on, face value has to be invested in rands. You put rands in there when you retire from your pension or your provident fund or your RA, and you draw income in rands. So that money can't technically leave the country and be, administered outside the country. But a living annuity has full flexibility to invest offshore within it. So I guess the answer is no, you can't put the living annuity in a wrapper, because a living annuity is its own tax vehicle, Nick. It's different from everything else. So you don't need to have a wrapper, because a living annuity is taxed in a very unique way. What often we do for clients is that clients will have a living annuity for their monthly income, and then they would have a wrapper for their offshore money, which is to grow. So the two can work side by side together very well. But yeah, a living annuity can't go directly into a wrapper itself.
Okay, great. Thanks, Stuart. We're going to wrap it up here. Thanks. I mean, this is an important subject. Hopefully it's helped everybody. If you have any further questions, drop us an email or you can phone us, and I'm sure we can help you further. Thank you so much for joining us. Cheerio.
Thanks, everybody.
Cheers.
Bye.
Bye.